Supermicro nearly doubled their top line this quarter, but the real punchline is they missed their own revenue target because their biggest AI customers literally ran out of electricity to plug the servers in. It's August 11th, 2026. You're listening to Earnings Unscripted, and today we're unpacking fiscal fourth quarter for Supermicro, ticker SMCI. These are the folks building the massive liquid-cooled server racks powering the whole AI boom. Samiro, bad news on sales timing, but strangely great news on profit line?
Exactly. It's a fantastic paradox. Revenue came in at $11.1 billion, which is a massive year-over-year jump, but it missed expectations. And yet, GAAP earnings hit $1.62 a share, blowing past estimates. Basically, their lowest margin hardware, those giant AI cloud contracts, got physically delayed by the power shortages you mentioned, which accidentally engineered a huge profit beat.
So, wait, missing their biggest orders actually made their profitability look better? That's hilarious. And the market seemed totally fine with the joke. The stock had a brutal mid-quarter drawdown, but after the bell, it just gapped up hard and held most of the gains. And as always, us trying to read the minds of after-hours traders is just personal opinion, not financial advice. But clearly, investors weren't panicking over the revenue miss.
Right, because the market saw gross margins jump up to 17.5%. I mean, that's a ridiculous expansion from last quarter. But here's the catch. Management admitted that margin spike is essentially a fleeting quirk. It was mostly that product mix shift plus a lucky break on suspended tariffs that they don't expect to last. So, the business is undeniably scaling. They have a staggering $60 billion backlog, but this quarter's profitability isn't the new normal.
Which perfectly tees up the weirdest thing in this report. You were looking at how they're calculating earnings per share for next quarter, and there's this completely novel math quietly redirecting net income, and I need you to explain what exactly they're doing there.
Right. So to understand the math, you've got to look at why they needed cash in the first place. Building AI infrastructure is brutally expensive. They just raised over $5 billion in new capital, and a massive chunk of that was mandatory convertible preferred stock.
Okay, so they printed new stock. Doesn't that just mean standard dilution? Like there's more shares in the wild, so the earnings per share automatically drops?
Not quite. It's a specific accounting quirk called the two-class method. Because these are preferred shares with mandatory dividends, you don't just increase the total share count denominator, you actually have to carve out a slice of the net income and assign it to the preferred shareholders first. So the profit pool left over for the common stock shrinks before you even run the calculation.
Oh, wow. So if a retail investor sees top-line revenue crushing it next quarter, they might still get blindsided by a soft earnings per share print just because of this invisible tax on the profit pool?
Exactly. The CFO explicitly warned analysts to factor that in. It structurally lowers the reported earnings base for common shares going forward. And honestly, it just highlights the sheer financial weight of operating in this space. I mean, they consumed nearly $7 billion in operational cash this past fiscal year just to buy parts.
$7 billion just sitting on hardware waiting for someone to plug it in, which completely explains why their days of inventory ballooned, right?
Yeah, they're holding 119 days of inventory right now. They're stockpiling components aggressively because they expect those delayed enterprise orders to finally go live in the first quarter. But floating that much working capital is exactly why they were forced to issue that convertible debt.
So they're taking on all this financing complexity essentially to serve as a giant physical shock absorber for the AI supply chain.
Pretty much. You can compile code in seconds, but you can't download a power grid. Their clients are constrained by cooling and electricity hookups, so Supermicro holds the bag on the inventory.
Which brings us to the other major risk hovering over that massive backlog. Analysts were pressing them about some pretty intense regulatory heat. They've got multiple SEC subpoenas and a Department of Justice indictment floating around?
Yeah, it was detailed in their filings from last quarter. The Justice Department indicted 3 former affiliates over conspiracy to commit export control violations, essentially allegedly routing restricted tech to China.
Okay, that's heavy. So they're building massive data center campuses, raising billions, all while navigating federal probes into where their hardware actually ends up?
Right, and it adds real friction to their forecast. We don't really know how much of that pure AI backlog might be exposed to tightening geographic restrictions, but management is still projecting record-breaking growth next year anyway.
And assuming they can actually ship the hardware legally, there's still the question of how much money they'll actually make doing it, because they also admitted a good chunk of this quarter's margin improvement came from a tariff suspension, right?
A very big chunk, yeah. A quarter of that huge sequential margin leap was driven by the suspension of IEEPA tariffs. It's essentially a hidden tax holiday, and they were surprisingly candid about it. The CFO literally said, "I think the rest of the industry is expecting that the tariffs may go back up. So that's why we still look at this as perhaps a one-time benefit."
Which really makes you wonder if this massive profit beat was a fluke of delayed deliveries and a temporary tax holiday. What does their baseline profitability look like when reality snaps back and they actually start fulfilling those contracts?
Well, it looks exactly like the business they're really in. Without that tariff suspension and with those giant lower margin AI orders finally going out the door, profitability will snap right back to earth. So the true baseline is heavy volume with very tight margins.
Right, which means they've got to sell an unbelievable amount of hardware just to justify the valuation. But they do expect to keep scaling, don't they? What's the management outlook?
Oh, they definitely do. For the full year, management's targeting somewhere between $65 and $72 billion in revenue. They're actually calling it a historic infrastructure build-out. But if you check the gross margin guide for next quarter, it drops back to somewhere between 10.4 and 10.8%.
Okay, so a massive step down from that profitability spike we talked about earlier. That's a brutal reality check. It feels like the entire story rests on the sheer physical scale of their factories. I mean, they're building that new 32-acre campus right in Silicon Valley.
Yeah, pushing 4 million square feet of manufacturing space just to meet that massive order backlog we mentioned a few minutes ago. It's purely a volume game now. The hardware bottleneck isn't getting the chips anymore. It's finding enough power to turn them on.
It really is. They're financing a revolution, stockpiling parts, and fighting regulatory ghosts all at once. We'll definitely be watching that cash flow line next quarter. I think that's plenty for us to chew on today. Thanks for hanging out with us, everyone.
Catch you next time.
To catch our next breakdown right when it drops, you might want to hit follow in your podcast app. And as a quick heads up, this show's entirely AI-generated, synthetic voices and all, going from Supermicro's actual earnings call to your feed the same day, since we don't have to wait on physical power grids to do our jobs. Tell us how we're doing, or shoot a ticker request over to earningsunscripted@datamadness.ca.
Catch you later.